Today, negative equity. Is the RBA bankrupt? Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and problem news with a distinctively Australian flavour. Well, the RBA Deputy Governor Michele Bullock spoke today about the review of the RBA's bond purchase program, the BPP, which was during the pandemic, and also the bank's financial statements for the year 21-22. Of course, the two issues are somewhat related because while the bond purchase program was a policy response to extraordinary economic circumstances, it did have a big implication for the bank's balance sheet, profits and capital. The bond purchase program was implemented by the bank as part of a package of measures designed to provide insurance against very bad economic outcomes as a result of the pandemic. And the bank's internal review of the program suggests that it broadly achieved its aims. But one outcome of the bond purchase and other policy measures has been that the bank will report a substantial accounting loss in its 21-22 annual accounts, resulting in the bank being in a position of negative equity. Although they say this will not, however, affect the bank's ability to operate. As the bonds mature and the bank's balance sheet declines, the bank will once again return to positive earnings. These earnings will result in the bank returning to positive equity over time, on the never-never. If any commercial entity had negative equity, assets would be insufficient to meet liabilities, and therefore the company would not be a going concern. But rest assured, she said, central banks are not like ordinary commercial entities. Unlike a normal business, there are no going concern issues with a central bank in a country like Australia, because under the Reserve Bank Act, the government provides a guarantee against the liabilities of the Reserve Bank. Furthermore, since it has the ability to create money, the bank can continue to meet its obligations as they become due, and so it is not insolvent. The negative equity position, therefore, will not affect the ability of the Reserve Bank to do its job. Indeed, a number of central banks in other countries have a similar issue, large bond portfolios that, if marked to market, will result in substantial accounting losses and potentially negative equity. But the Reserve Bank of Australia is unusual in using market value accounting without an indemnity from the government. For example, both the Bank of England and the Reserve Bank of New Zealand use market value accounting for securities purchased under their equivalent bond purchase programs, but their profits are unaffected by mark-to-market gains or losses because they're offset by a matching entry that reflects the value of their indemnity. It is a number wang. And she went on to say the bank's balance sheet is actually relatively simple. On the asset side, the bank essentially holds domestic bonds either outright or under repurchase agreements and foreign exchange reserves. Prior to 2020, the bank's balance sheet was between $150 billion and $200 billion. Most of the assets were either foreign exchange reserves or domestic securities held under repurchase agreements as part of the bank's liquidity management. It actually held very few domestic bonds outright, but that changed drastically during the pandemic when the bank undertook novel measures to lower interest rates. This resulted in the bank's balance sheet expanding significantly. The bond purchase program, combined with other policy responses to the pandemic, resulted in the bank holding around $356 billion in AGS and semis at the end of June 2022. It also had a further $188 billion in assets associated with the term funding facility. That's the cheap money, of course, they lent to the banks. The bank's main liabilities are deposits by financial institutions, the ES balances, government deposits and banknotes. Prior to the pandemic, banknotes accounted for most of the bank's liabilities, with deposits making up most of the rest. But the BPP and the TFF resulted in a significant change in the bank's liabilities, with ES balances increasing to over $450 billion. That, of course, is the reverse repo process, easily becoming the biggest component of liabilities. The bank also holds a number of equity reserves on its balance sheet. And the Reserve Bank's earnings come from two sources: underlying earnings, the most important of which is net interest income, less operating costs, and valuation gains or losses on holdings of government bonds and foreign exchange. The bank's net interest income is the difference between the interest it receives on its assets and the rate it pays on its liabilities. The bank earns a market rate of interest on almost all of its assets. On the liability side, the bank ordinarily pays interest on most deposits, but importantly, it does not pay interest on banknotes outstanding. So, prior to the expansion of the bank's balance sheet in 2020, it paid no interest on over half of its liabilities. If the average rate earned on its assets is greater than the rate paid on its liabilities, the bank will have positive net earnings, and indeed historically that has been the case. Underlying earnings, which subtracts operating costs, which have been positive since the bank was established in 1959. And over the past couple of years, underlying earnings have been particularly strong. In 21-22, underlying earnings were $8.2 billion. This reflects interest earnings through the year on the large portfolio of Australian government bonds purchased under the various pandemic programs, while paying no interest on almost all liabilities, banknotes and, until May 2022, ES balances. The other component of the bank's earnings is valuation gains and losses arising from fluctuations in the value of its assets due to movements in exchange rates or changes in the market yields on securities held outright. As the bank applies fair value accounting for its financial statements, such movements have an immediate impact on earnings. Over the past year, valuation losses on the bank's holdings of domestic bonds due to the rise in bond yields were around $40 billion. In addition, because they purchased many of those bonds at a price higher than their face value, the amount of this premium will also be recorded as a loss over the life of the bond. Over the past year, this accounts for a further $5 billion valuation loss. Now, those valuation losses are partially offset by a net $1 billion valuation gain on the bank's foreign assets from the depreciation of the Australian dollar over the year. The net impact of these two forces is that the Reserve Bank will announce a significant accounting loss when it releases its financial statements in October. So this leads to the question of how such a significant loss is treated. But first, a bit of background on the bank's capital and reserves. The Reserve Bank holds a number of reserves, the most important one for current discussions being the Unrealised Profit Reserve, the UPR, and the Reserve Bank Reserve Fund, the RBRF. Both of these reserves are set out in the Reserve Bank Act 1959. There are also a number of accounting reserves, which she didn't discuss any further because they don't really impact the results. The UPR functions as the name suggests. While unrealised valuation gains are reflected in profits, they are not available for distribution. Instead, they're placed in a reserve to either absorb any unrealised financial losses in future or become distributable when profits are realised from a sale or maturity of the underlying asset. The RBRF is the bank's main reserve and historically constituted the bulk of the bank's capital. The framework used by the Reserve Bank Board to determine the target balance of the RBRF has been in place for a number of years. Under that framework, capital was assigned to cover market risk arising from the bank's portfolio of foreign and domestic asset holdings. A small amount of capital was also assigned to cover credit risk arising from the very small exposures to commercial banks that are not collateralized. The target balance in the RBRF is not a minimal level of capital that needs to be maintained at all times, but rather a benchmark for the board to consider when providing advice to the Treasurer regarding the bank's capital and dividends. The Reserve Bank Act sets out how those reserves are utilised when the bank makes a profit or loss. Unrealised gains are not available for distribution and are transferred to the UPR. Unrealised losses are first absorbed by the UPR. In the event unrealised losses exceed the balance of the UPR, they are offset against other sources of income. If after this, distributable earnings are positive, the Treasurer determines after consulting the Reserve Bank Board any amounts to be transferred from distributed earnings to the RBRF, and the remainder of the earnings is payable as a dividend to the Commonwealth. If, however, the unrealised losses are so severe that they totally deplete all other income, the RBRF is used to absorb the losses. The Act is, however, silent on what happens if the RBRF isn't large enough to absorb the remaining losses. So, now how is this playing out in the year 21-22? Well, in 21-22, the Reserve Bank recorded an accounting loss of $36.7 billion. While underlying earnings were $8.2 billion, valuation losses were $44.9 billion. Only $0.5 billion could be absorbed by the UPR, so there still remains $36.2 billion in losses to distribute. The RBRF absorbed $15.4 billion of this before it was exhausted, leaving around $21 billion in losses. This will be recorded as accumulated losses on the bank's balance sheet. This means that the bank has negative equity. Now, despite the fact that the bank can continue to operate with negative equity, the board's view is that it is important that the bank return to positive equity over time. So the board has communicated this to the government. While it has not sought a capital injection, the board has indicated to the government that it expects that future profits will be retained by the bank until the bank's capital is restored. The Treasurer has endorsed this general approach, noting that under the Reserve Bank Act, the issue of distributions to the government is considered each year. One reason why they expect profits in the future is that the majority of the bank's domestic bonds are now carried on the balance sheet at a value less than these bonds will be redeemed at on maturity, so that capital gain can be expected to be realised as these bonds mature, and that will add to the bank's earnings in future periods. Furthermore, the bank is continuing to earn seniorage on the banknotes it issues. Offsetting this, however, is the fact that over the next few years, the interest rate the bank earns on its domestic bond holdings is likely to be less than the interest it's paying on ES balances. Indeed, as monetary policy has been tightened over the past 5 months, the interest rate paid on ES balances has been rising, and we're now in a position where, on average, the interest being earned on our assets is less than the interest being paid on our liabilities. In other words, underlying earnings are negative. She went on to say it's difficult to be precise about how long this situation will last or how big these negative earnings will be. The review of the BPP set out 4 scenarios to illustrate how the bank's future earnings may vary with different assumed paths for policy rates, and we can use those scenarios to get some idea of the potential future path of the bank's earnings and negative position. The bank would incur losses for the next few years as the interest rate on ES balances would be higher than income on the bank's assets, especially funds lent under the Term Funding Facility. But valuation gains on the bank's domestic bonds will also boost earnings, and within a few years it's expected they will more than offset negative underlying earnings. At that point, negative equity will begin to improve. The other factor that will lead to an improvement in profit and net equity is a reduction in the size of the balance sheet. Prior to the pandemic, the more usual situation for the bank was a much smaller balance sheet in which banknotes paying no interest accounted for most liabilities. And as the bank's bond portfolio matures, ES balances will run down and they will move back towards a situation with positive income and much less exposure to interest rate risk. But it's worth noting that the AGS that the bank holds are actually liabilities issued by the government. So while the bank will report a large valuation loss in 2021, the government's debt issuer, the Australian Office of Financial Management, AOFM, will report a significant valuation gain. So for the whole of government, therefore, the bank's loss on this part of the portfolio is netted off against the AOFM's gain. Another example of wonderful number wanging, because one part of government owes somebody else in the other part of government the mirror image, and the two are netted out. Now, 2 observations here. Of course, the RBA is not going to fall over simply because it's in negative equity, but it does highlight the mismanagement, I think, over recent years. Secondly, of course, the Term Funding Facility is now extremely expensive because they are paying very significant amounts back to the banks for the exchange settlement balances that the banks are placing with the Reserve Bank. That was not conceived in the original model because interest rates were expected to stay low at least till 2024. Remember that? And by then, of course, the Term Funding Facility would have been paid off. So in other words, some of the issues that have been created because the RBA got its forecasting wrong, it set its rates wrong, and therefore it's now having to actually respond to a much stronger bond yield rate than originally expected. And that is the root cause of the negative equity we've got. It's a symbol of the mismanagement of the bank over the last few years, once again. And I'll underscore the point that because one part of government is offset by what happens elsewhere, the overall government doesn't mind. But I think we should be concerned because to me this is once again another symbol of bad planning and management from the RBA over at least the last 4 or 5 years. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.